Discover 5 hidden dividend powerhouses in Singapore that consistently beat traditional REITs and blue chips with yields exceeding 6% annually. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've produced over 600 videos with more than 280,000 watch hours as of November 2024. I also focus on regional and world economy topics. Think about your favorite hawker stall. Just because it was great last year doesn't mean it's still the best choice today. Think about your favorite hawker stall. That's exactly what's happening with traditional dividend stocks right now. Those familiar names like Mapletree Pan, Asia Commercial Trust, and DBS are feeling the squeeze from high interest rates. Hey Iguana fam, Iggy here, and today we're diving deep into some exciting trends in the Singapore stock market, especially when it comes to dividends. Now you might think dividends are just for those old established companies, right? Wrong. What's really interesting is that we're seeing a major shift in who's actually paying out these dividends. It's not just the usual suspects anymore. We're talking about companies in sectors that weren't traditionally known for dividends, like technology. This is a huge change and something we need to pay close attention to as investors. For instance, think about the rise of tech companies in Singapore. They're not solely focused on rapid expansion and reinvesting every single dollar anymore. Many are now generating substantial cash flow, allowing them to reward shareholders with consistent dividends. This signals a maturity in these companies and a shift towards sustainable profitability. It's a sign they're not just burning cash for growth, but actually building real, profitable businesses. Let's take a closer look at how this plays out in the market. We're seeing more and more tech companies in Singapore adopting a dividend-paying strategy. This wasn't the norm a few years ago. Traditionally, tech companies would prioritize reinvesting profits back into the business for research and development, expansion, and acquisitions. However, as these companies mature and generate more stable revenue streams, they can afford to distribute some of that profit to shareholders. This is a very positive sign for investors because it indicates the underlying strength and stability of these businesses. It also makes them more attractive and generate more stable revenue streams. They can afford to distribute some of that profit to shareholders. This is a very positive sign for investors because it indicates the underlying strength to a wider range of investors, including those who prioritize income generation. This shift towards dividend payouts in non-traditional sectors like tech is a clear indicator of the evolving landscape of the Singapore stock market. It's a trend that's worth keeping an eye on as it presents new opportunities for investors seeking both growth and income to a wider range of investors, including those who prioritize income generation. This shift towards dividend payouts, right? So another big shift we're seeing is how companies are actually making their money. It's not just about selling more of the same stuff. It's about evolving the business model itself. Think about nanofilm technologies. They started out doing one thing, but they've pivoted towards advanced materials solutions. This is huge. It's kind of like taking a traditional kopitiam, right, that serves kaya toast and kopi, and transforming it into a modern food delivery platform. You're still essentially in the food business, but you're reaching a wider audience, streamlining operations, and potentially boosting your profit margins significantly. This kind of transformation is happening across various sectors in Singapore. Companies are realizing that simply increasing sales isn't always the most efficient way to grow. Sometimes it's about innovating the core business model to unlock new revenue streams and improve profitability. For example, some retail businesses are shifting towards e-commerce and omni-channel strategies, while others are focusing on subscription models or value-added services. This is a crucial strategy for sustained growth in today's dynamic market, especially in a competitive environment like Singapore's. All right, folks, let's dive deeper into this exciting world of mid-sized Singaporean companies making waves in Southeast Asia. We're not just talking about small-time operations here. These companies are seriously expanding their reach and influence. Take UMS Holdings, for example. They've strategically grown their semiconductor business by catering to a diverse customer base throughout the region. This isn't just about selling a few extra products. It's about establishing a strong regional presence and becoming key players in their respective industries. What's even more appealing for us as investors is that these companies aren't just hoarding their profits. They're sharing the wealth through dividends, which means regular payouts directly to your pocket. This is a fantastic way to generate passive income while being part of their growth story. Think of it as owning a slice of a growing pie. As the company expands and becomes more profitable, your slice and therefore your dividends can potentially grow as well. It's a win-win situation. Now, why is this Southeast Asia expansion such a big deal? Well, this region boasts a rapidly growing middle class and increasing consumer spending. According to reports, Southeast Asia's digital economy is booming, with internet penetration rates steadily climbing. This creates a huge market for these Singaporean companies to tap into. They're not just limited to the local market anymore. They're accessing millions of new potential customers. This expansion also offers diversification benefits, reducing reliance on the Singaporean economy alone. By spreading their operations across different countries, these companies can mitigate risk associated with economic downturns in any single market. This strategic move not only boosts their revenue potential, but also strengthens their overall business resilience. Let's talk about how companies evolve and why that's crucial for us as investors. You see, the market isn't static. It's a living, breathing thing, constantly changing. Just like how we adapt to new situations in life, companies need to do the same to stay relevant and profitable. Take AEM Holdings, for instance. They didn't start out as the powerhouse they are today. They began by focusing on basic testing solutions, but they didn't stop there. They recognized the changing landscape of the semiconductor industry and strategically expanded their offerings to become a global leader in comprehensive testing solutions for both semiconductors and electronics. This kind of adaptability is gold in the investing world. It shows a company's management is forward-thinking and committed to long-term growth. This growth is often reflected in a company's financials. For instance, AEM has not only expanded its business, but has also maintained a sustainable dividend policy. This is a great sign for investors, as it shows the company is not just focused on reinvesting for growth, but also rewarding its shareholders. According to their financial reports, they have been able to consistently increase their revenue and profitability over the years, which is a testament to their successful adaptation and strategic planning. Now, why is this important for you and me as investors? Well, it highlights the importance of not just looking at a company's current performance, but also its potential for future growth and adaptation. We need to look beyond the surface and understand the company's business model, its competitive landscape, and its management's vision. A company that's stuck in its old ways, refusing to adapt to market changes, is likely to struggle in the long run. On the other hand, a company that's constantly innovating, expanding into not just looking at a company's current performance, but also its potential for future growth and adaptation. We need to look beyond the surface and understand the company's business model, its competitive landscape, and its management's vision. A company that's stuck in its old ways, refusing to adapt to market changes, is likely to struggle in the long run. New markets and investing in its future is much more likely to deliver strong returns for its investors. AEM's journey shows us how a company can evolve and thrive over time. They've demonstrated the importance of adapting to market changes, investing in research and development, and maintaining a sustainable dividend policy. These are all key factors that contribute to long-term success, and these are the kinds of companies we want in our portfolios. All right, so you're eyeing some dividend stocks. That's fantastic. But before you jump in head first, let's pump the brakes a little and talk about some crucial things to look out for. It's like buying a house. You wouldn't just be wowed by the fancy paint job, would you? No way. You'd be checking the foundation for cracks, making sure the neighborhood is safe, and definitely haggling over the price. Same goes for stocks, especially dividend stocks. First things first, check out the payout ratio. This tells you how much of a company's earnings they're dishing out as dividends. Now, a high payout ratio, say above 80%, is a red flag. It's like someone spending more money than they actually earn. It's unsustainable in the long run. Imagine if you consistently spent $1,000 when you only earned $800 each month. Eventually, you'll run out of savings and be in deep trouble. Same goes for companies. They need to reinvest some of their earnings back into the business for growth and to stay competitive. If they're paying out almost everything, there's little left for research and development, expansion, or weathering unexpected storms. Next up, take a good hard look at the company's debt levels. High debt combined with high dividends is a recipe for disaster. It's like someone maxing out their credit cards to fund a lavish lifestyle. Sooner or later, the interest payments become overwhelming and they can't keep up. Similarly, a company burdened with debt might be forced to cut dividends to service their loans, leaving you, the investor, high and dry. In Singapore, many investors are drawn to REITs, real estate investment trusts, for their dividends. While REITs often have higher payout ratios due to their structure, it's still important to examine their gearing ratio, which is a measure of their debt. A high gearing ratio means they have a lot of debt relative to their assets, which can make them more vulnerable to interest rate hikes. Finally, and this is super important, make sure you understand how the company actually makes its money. If you can't explain their business model to your parents or your grandparents, chances are you don't fully understand it yourself, and that's a big problem. You shouldn't invest in something you don't understand. It's like gambling. You're just hoping for the best without any real knowledge. Investing should be based on careful analysis and understanding, not blind faith. Now, while we're talking about dividends, it's not just the usual suspects like DBS and OCBC that are worth a look. Sure, they've got that long track record, those decades of consistent payouts, which is great for stability. But sometimes you gotta look beyond the blue chips to find some real hidden gems. Take Franken Group, for example. They might not have that same long history of dividends, but they've been consistently paying out while also expanding their high-tech manufacturing business. That's a sign of a company that's not just focused on returning value to shareholders, but is also reinvesting for future growth. And that's the kind of balance you want to see. It's important to remember that past performance is not indicative of future results, but looking at a company's ability to maintain dividends while growing is a positive sign. According to Bloomberg, Franken Group has shown steady growth in revenue over the past few years, which supports their ability to maintain and potentially increase dividends in the future. This kind of growth combined with consistent dividend payouts can be very appealing for investors looking for both income and capital appreciation. Thinking about the bigger picture, the whole dividend landscape is shifting. We're seeing traditional dividend powerhouses facing pressure, while tech and consumer companies are starting to become dividend payers. This is a big change from the past, when these sectors were more focused on reinvesting profits for growth. We're also seeing regional expansion opening up new opportunities for dividend investors, especially in Southeast Asia. And it's not just the big boys. Mid-cap companies are also stepping up their dividend game, offering attractive yields and growth potential. This is especially relevant in Singapore, where the mid-cap segment is quite robust. According to the Singapore Exchange, SGX, the mid-cap segment has seen increased trading activity and market capitalization in recent years, indicating growing investor interest. This shift in the dividend landscape means investors need to be more discerning and look beyond the traditional dividend stocks to find the best opportunities. Diversification across different sectors and market caps is key to building a resilient dividend portfolio. Now, looking ahead to 2025, it's like watching a well-orchestrated financial symphony. We're seeing companies like Keppel DCREite really focus on sustainable dividend growth. This isn't just about throwing out cash now. It's about building a solid foundation for consistent payouts in the future. This is important because it shows the company is confident in its long-term prospects and its ability to generate steady income. Plus, the Singapore Exchange itself keeps attracting quality dividend-paying companies. This is a big deal because it means there's a growing pool of potential investments for U.S. dividend investors. It's like a buffet of income-generating opportunities, and who doesn't love a good buffet? This trend is also supported by Singapore's stable economic environment, which encourages companies to distribute profits to shareholders. For instance, the Straits Times Index, STI, a key benchmark for the Singapore stock market, historically has provided a decent dividend yield, averaging around 3 to 4% in recent years. This consistent performance further strengthens the case for dividend investing in Singapore. Think of it this way. These companies aren't just handing out spare change. They're sharing a piece of their success with their shareholders. And with the Singapore Exchange attracting more of these dividend-focused companies, it's like the dividend party is just getting started. This is particularly relevant in Singapore, where many investors rely on dividends to supplement their income, especially during retirement. According to the Singapore Department of Statistics, the median monthly household income from work was 10,099 in 2022. Dividends can play a significant role in boosting this income, especially for those who have built a substantial investment portfolio. Moreover, with the increasing focus on ESG, environmental, social, and governance factors, many of these companies are also prioritizing sustainable business practices, which can further enhance their long-term value and dividend-paying potential. It's a win-win situation for both the companies and the investors. Want to learn more? Check out my video on Singapore's Dividend Kings 2024. It's the perfect companion to this one. Hit subscribe if you haven't already, and smash that like button if you found this helpful. Remember, smart investing isn't about following the crowd. It's about spotting opportunities before everyone else does. See you in the next video.